series of elements have been dominating concerns about how various policies impact the economy, and some of those have been prevalent in the coverage here at the Center Square. Welcome back to the States. I'm Greg Bishop. For Everyday Economics this week, I talked with PhD economist Orphe Divounguy about 4 inflation accelerators that the Federal Reserve did not create, but they now own. We're talking about 4 inflation accelerators the Fed did not create, but they now own. Orphe, we talked previously about some of these, but even if the labor market stays balanced, you got 4 concurrent demands and cost shocks. War in the Middle East, tariffs imposed by the Trump administration, exploding fiscal deficits, which are taxpayer-funded, and something else that is getting more attention, the AI data center boom. All these things pushing inflation risks higher. The question is no longer when will they cut, but how hard do they have to push back?
Yeah, I mean, we got a Fed meeting coming up this week. You know, war reaches consumers through through more than oil, right? As the price of oil is shipping routes. When ships avoid critical routes, delivery times lengthen and transportation costs rise. Firms may then pay premium trucking and air freight costs to make up for lost time. Those higher costs eventually reach stores, factories, and consumers, right? So energy shocks can spread into airfares, food distribution, manufacturing, plastics and chemicals, delivery, and logistics. Then it's the tariffs. It started over a year ago now, but unfortunately, a lot of the tariffs collected at the border eventually get paid by consumers, right? Why? Because U.S. importers pay the tariffs. They absorb the cost at first, and then ultimately they pass it on. And so, you know, we have nearly half of firms that pay the tariff saying they still have to pass on those costs to consumers, and they will. And so that's pressure that isn't going away anytime soon. The AI boom is also an inflation story. AI is usually discussed as a productivity revolution, or you see it in the stock market and the big stock market story. But the investment boom is already pushing demand for chips, servers, electricity, construction workers, engineers higher, right? And so that is a big spend that's showing up on the demand side of the ledger. And then, of course, there's deficits. And deficits are really interesting because they do not automatically cause inflation. It could be when borrowing appears permanently funded, right? Unfunded, I should say, right? When there are no taxes or expected tax hikes or spending cuts coming in the future, then that's when higher deficits cause higher inflation, higher interest rates, or potentially both, right? The Treasury plans to spend $671 billion this quarter alone. And of course, that's going to put some upward pressure. And I think it's going to put upward pressure on inflationary interest rates because we very well know that the trajectory has been up and not down. We haven't had conversations about tax reform or spending cuts, right? We know entitlement spending is on the rise. We know, right? You look at the trajectory of Social Security, that's a problem. We know that Americans are getting older, and so healthcare spending is on the rise. And so there's no real plan. And because there's no real plan, we're likely to see it in inflation and at the very least, higher interest rates. And that's basically the story here. Inflation expectations are also moving slightly higher. Household inflation expectations. 1-year inflation expectations are at 3.7%, 3-year at 3.3%. The Fed is not going to just look at that and do nothing, right? And that's the problem. So for now, maybe nothing in July, but if things continue that way, I expect maybe one rate hike in the near future. And sadly, I want to say sadly because it is sad, the Fed doesn't raise interest rates just once. It usually just goes in a sequence. And so if inflation continues to move higher and inflation expectations continue to move higher, if we see a reacceleration in the labor market, right, or labor shortages, because unemployment is really low, then and you start to see wage growth picking up a little bit, then all bets are off. We might have to live in this higher interest rate, that higher for longer interest rate environment that everybody feared.
Orphe, a lot of things going on here, right? I mean, these four major shocks, several of them kind of as old as humanity is, right? I mean, war, you've got tariffs, and then you have government deficit spending. But it seems this new one that everybody's been top of mind is that AI build out and a lot of investment, $1.5 trillion announced.
Yes.
Right? I mean, that's nothing to sneeze at. But you even have the Fed governor in the July Beige book already linking it to higher chip, equipment, software, and specialty construction prices when it comes to the wages there. Again, delve a little bit more into just the overall impact on the economy from that
absolutely.
new, initiative.
In the short run, it's a ton of spending. Hopefully, and I say hopefully because it's not guaranteed. Hopefully, in the long run, you get a big boost in productivity that ends up reducing costs. Right? That's the big hope. But as of right now, it's a lot of spending, and that spending is essentially fuel to the inflation fire that hasn't fully died down yet from a few years ago, from the COVID pandemic, really that basically reignited that fire.
Now, these shocks, some are, things that we just can't see what the end is going to be like, whether it's temporary, like the Middle East conflict with Iran and the impacts on oil. But do these shocks become sticky at any point? Do they stick around and then actually have much longer impacts?
Yeah, I think that's it. It's the impact that could become sticky if inflation expectations start to move higher. If households start to believe that oil prices will be higher next week, and that the price of everything else is going to continue to increase, well, the rational thing for households to do is to go out and buy all the stuff and store it now, right? And so that adds more fuel to the demand side of the inflation story.
And when it comes to, who owns this, some may argue that the taxpayers and the consumers ultimately are the ones holding the bag on all of this. But who ultimately owns the higher rate path? And what does that mean for Fed independence?
It's consumers, it's taxpayers. It's ultimately you're saying if you're not getting a higher tax bill, you're getting a higher inflation tax bill, right? So that's the bottom line. It's higher inflation, but it's also higher interest rates. For a couple of years now, we've kind of had this sluggish housing market because interest rates have remained elevated. The 10-year Treasury yield, a direct result of more and more borrowing by the federal government, right, is pushing rates higher, credit cards, mortgage rates. So when you look at that mortgage rate and you wonder why it is that you can't make that move just yet, all you have to do is look at what's going on in Washington, D.C. All you have to do is look at what's going on. What are those forces? I know a lot of people like to blame the Federal Reserve, but ultimately the Federal Reserve is only having to react to the fiscal policy forces at play, but also on top of the shocks. What are those shocks? A war that caused oil prices to increase, right? Tariffs that caused the price of everything to increase, right? And so you have
deficit spending that's caused the possibility of taxes and
spending that's out of control and that no one's talking about reining in. And so, when you think about all of those things that are happening in the U.S. economy that are keeping interest rates elevated, it's not the Fed. Ultimately, the Fed has to respond. And the only reason the Fed responds is because it needs to rein in inflation. It needs to make things affordable for households again. It needs to make sure the labor market remains stable, right? It needs to make sure that prices are not running up out of control, right? And so to some extent, I'm happy we have an independent Fed to try to rein in kind of the craziness that is causing all of this pain felt by everyday Americans.
Well, Orphe, I was going to wrap things up asking you to get out a crystal ball and give us an idea of what the rest of 2026 looks like. But we've got 6 more months till the end of the year, so we can delve into that deep question at another time. Greatly appreciate your time and your expertise as always. Dr. Orphe Divounguy, PhD economist. I'm Greg Bishop, and this is Everyday Economics, brought to you by the Center Square.